What if every financial collapse you've ever seen wasn't a failure? What if every bailout, every rescue, every so-called emergency wasn't a mistake, but part of a hidden design? Imagine a system where crises aren't anomalies, they're required. A system where collapse justifies intervention. Intervention inflates assets and ordinary people unknowingly fund the cycle. We're told the markets crash because of greed, pandemics, or mismanagement. We're told bailouts are emergencies, temporary lifelines for failing institutions. But the evidence suggests something far more organized. If you think economic collapses are accidents, or that bailouts are charitable acts, this video will challenge everything you thought you knew. By the end of this journey, you'll see that the architecture of collapse isn't broken at S, perfectly designed to repeat itself. The consequences are more personal than you realize. Act I, setting the stage. A history of crisis to understand today. We have to start with yesterday. Money before central banking. For most of human history, money had limits. Gold, silver, and other commodities ensured value couldn't be arbitrarily created. Credit existed, but it was measured, constrained, and risky. In this world, economic collapses happened. Yes, but they were cleansing events. Failed businesses, bad investments, and reckless banking were punished. Painful? Absolutely. But consequences reset the system. The 20th century turning point. Everything changed with the creation of central banking. In the U.S., 1913 marked the birth of the Federal Reserve. Suddenly, money creation was centralized. Credit could be expanded or contracted at will. Governments could intervene on unprecedented scales. Crises could be managed, sometimes even prevented. But here's the twist. Central banking didn't eliminate collapse, it re-engineered it. By controlling liquidity, interest rates, and the supply of money, central banks could determine which institutions fail and which survive, effectively shaping the financial landscape to their design. The rise of big finance. By the mid-20th century, finance had consolidated. A handful of institutions dominated banking, investment, and international lending. Names like J.P. Morgan, Goldman Sachs, Citibank, and later multinational banks became too powerful to fail. This concentration of power is critical. A system where only a few players hold most of the cards is inherently fragile, but it's also controllable. Act 2. Origins of a system built on debt. Debt isn't a side effect of capitalism at S, the core of modern finance. Debt is a feature, not a bug in today's economy. Almost all money exists as debt. When a bank lends, new money is created. Loans are repaid, money disappears. This isn't theory, it's mathematical reality. If the economy wants to grow, debt must grow faster. And as debt grows, the system becomes increasingly dependent on expansion. This creates a paradox. The economy can never stop expanding without risking collapse. And whenever expansion slows, intervention is required. The mechanics of bailouts before 20th century central banking, financial collapse, meant losses for investors and institutions alike. Now, when a major institution is at risk, governments step in. Creating bailouts, trillions of dollars are printed or borrowed to save failing entities. The effect is clear. Losses or socialized gains remain privatized. Risk becomes rewarded without consequence. This flips capitalism on its head. Risk no longer carries natural consequences, it carries protection. And as a result, institutions behave recklessly because they know they are too big to fail. Act 3. The rise of the bailout era. The modern cycle of bailouts begins in earnest in the latter half of the 20th century. 1971. Nixon abandons the gold standard, allowing money to float freely. The world enters a new era of fiat currency money created by government decree rather than tangible value. 1980s. Financial deregulation fuels rapid credit expansion. Savings and loan crises demonstrate that when institutions are left unchecked, disasters follow, but they are rescued at taxpayer expense. 1997. Asian financial crisis highlights how global capital flows can be manipulated, triggering intervention from the IMF and central banks. Each crisis is framed as a failure, but the pattern is undeniable. Collapse occurs, gives intervention follows, gives system survives, gives cycle repeats. Act 4. The blueprint revealed. 2008 was different. the mortgage-backed securities crisis exposed the hidden skeleton of the global financial system. Banks had created layers of toxic assets, bundled them, and sold them as safe investments. The collapse was systemic. When it hit, governments had a choice: let the system reset or intervene. Trillions were injected into banks. Central banks slashed interest rates to zero. Quantitative easing began expanding money supply massively. The critical revelation: bailouts were no longer exceptional, they were policy. This created moral hazard on a global scale. Institutions now understood explicitly that they could gamble with impunity because the system itself would protect them. Act V manufactured stability post-2008. The illusion of recovery dominates. Stock markets rebound to record highs. Housing markets recover selectively. Corporate debt explodes. Yet for ordinary citizens, wages stagnate, inequality grows, and debt burdens climb. Stability isn't natural, it's manufactured. Central banks prop up markets, governments intervene, and policy cushions any real consequences. The result? A rigged system. Financial elites thrive while risk and loss are shifted to the public. Act V. Why collapse is necessary here? The unsettling truth. Collapse is built into the system. Every crisis provides fear that justifies intervention, urgency that expands power, opportunity to restructure the system in favor of central institutions. Bailouts aren't mistakes. They are designed to reinforce the architecture. Without crisis, central banks and governments cannot justify unlimited control or debt expansion. Act 7. Modern parallels and shocking data. The patterns we've seen repeat with alarming regularity. Global debt. Over $300 trillion today, far outpacing global GDP. Central bank balance sheets expanding exponentially. Holding trillions in assets purchased from private institutions. Inequality. The top 1% now owns more wealth than the bottom 50% combined, and every warning sign is accompanied by a narrative. Temporary measures, emergency interventions, once-in-a-generation crises. The reality: the system cannot return to normal. Permanent bailouts, permanent intervention, and permanent instability are now the status quo. Act 8. Failed fixes and false solutions. Every proposed reformed odd. Frank Shake's tests, financial regulations, has one thing in common: it defers collapse, but does not prevent it. And why? Because the system is engineered to require growth and debt. To fix it would require allowing major failures, reducing leverage, significantly limiting the power of central banks. None of these are politically feasible. Instead, each solution inflates the next bubble, creating an even larger crisis down the line. Act 9. The human cost. While institutions are insulated, ordinary people face the fallout. Rising inflation erodes purchasing power. Wages stagnate despite economic growth. Pension funds and retirement savings are exposed to market manipulation. The architecture of bailouts is hidden from the public, yet its effects are felt in every household. Debt, unemployment, and rising costs are the silent tax of a rigged system. Act X. 3 key takeaways. 1. Bailouts are structural reinforcements. Not emergencies, they are part of a deliberate design to preserve the system, protect elites, and socialize losses. 2. Collapse is necessary to justify expansion. Without crises, central banks cannot intervene and grow their influence. Instability is not a fluke, it's a feature. 3. The system is rigged, not broken. Ordinary citizens bear the risk, while institutions profit endlessly. Understanding the cycle is the first step toward awareness and resilience. Final warning, open-ended thought: every system built on postponing reality eventually reaches its limit. The question isn't if the next collapse will happen, it's when, and whether people will recognize it before it becomes catastrophic. The architecture behind bailouts is invisible, yet omnipresent. Understanding it isn't just academic, it's survival knowledge, because once bailouts are infinite, so too is the control of those who engineer them. Call to action: if this video reshaped the way you think about money, debt, and collapse. Share it with someone who still believes bailouts are temporary. Subscribe for more deep dives into the hidden systems that control your financial world, because the most dangerous forces are often the ones we never see.